What's going on, everybody? It's Joe Giunta with Team Take Profits. I'm here to help you trade and get paid. Guys, I got something special for you today. It's going to be amazing. I'm about to give you the game on something powerful, but you got to stay tuned. Now, before we get to that, though, I want to let you know I got a giveaway. I'm about to bless somebody here today, but you got to wait till the end of the video to find out who. So, if you want to be that person, make sure you stay tuned to the end of the video and you watch and see, because I'm about to bless somebody today. All right, before we get to that video, as always, like, comment, subscribe, click that little bell so you get notified when we drop new content. So now, let's take it to the video. What we're going to talk about today is the best indicator in Forex trading. I promise you, this is the most powerful indicator that there is, period. You want to know about it? Watch the video and stay tuned to the end. Let's get it. All right, guys, let's take it to the charts. I'm going to talk to you today about what I feel is the most powerful indicator out right now. It is absolutely just awesome. And you guys know I'm a price action trader. I don't really rely on indicators to tell me how to trade as much as to confirm what price action is already telling me. So again, if you've been around the channel a while, you know that I'm a price action trader, and I trade levels, I trade supply and demand, and I allow market structure to dictate what I'm going to trade. And then I go to indicators or oscillators to essentially tell me or confirm to me what it is that the price action is already telling me. So I want to show you this. Before I actually show you the indicator itself, I'm going to show you kind of what the indicator is based off of. And so we're going to look at the GBP AUD, because you know that's all I trade. We're going to look at the GBP AUD chart, and we're going to look at the 1 hour. Many of you may have heard of the ATR, or what's known as the average true range. And what essentially the ATR is, and what it does, is it basically gives you exactly what it sounds like. It gives you the average true range, or in other words, the distance between the highest point and the lowest point of a certain time period over the last however many time periods that you have set. So in this case, it's a 14, which is a standard setting for most oscillators. It is going to give us the average range of how much movement we had from top to bottom, from high point to low point of the life of that candle for the last 14 candles. So we're getting basically the average range from high to low of each of the last 14 candles, and that's essentially what it's given us. So basically what it does is it takes the high, subtracts the low, and whatever that difference is, it adds it 14 times. So whatever the total is for each of the last 14 candles, it adds them together and then divides that number by 14. It gives you the average number of pips that has moved in each candle over the past 14 time periods. And so that could be adjusted 26, 24, 30. Some people use different time, different periods for different pairs, for different time frames. And so it really just depends on what you're doing. But I'm just going to show you the standard setting, which is 14. If you look here at the very tip of this line down here, the ATR, what it's saying, if you look right here in this number that comes up on your indicator or your oscillator, it's showing you that you've had 48 pips, okay, average movement over the last 14 candles. So from top to bottom of each candle, you've had an average of 48 pips. On average, each candle is moving about 48 pips per hour. So in this case, it's an hour. So you're essentially moving at a rate, a speed, a velocity, a range is the accurate word, of about 48 pips per hour. What that does is it allows you to really, knowing what the average movement is, you're pretty safe taking that as you're looking for the breakout. So essentially, because you see this is sideways movement, if you know you have a 48 here, you could times that by 1.5, or some people do 2. Some people would do times that by 2, and you could essentially use that as your stop loss And that would generally give you a good safe stop loss for your next breakout trade. It's a really powerful tool. ATR is very powerful. It's very strong. A lot of different ways to use it, which I'm not going to get into tonight. Here's my issue with the ATR. And I've been seeing a lot of people talking about it recently. It's becoming a more popular indicator, oscillator. The ATR is only going to show movement. Number one, it's not a directional indicator. So for example, you see here where we have a very strong drop in the market, but we see that the ATR is actually going up, okay? And then it ends up going down here a little bit, but even here it's going down and price action is going up. Because the ATR is not a directional indicator. Here's another example. You see here where price action is consistently moving up, whereas here you see that the ATR is moving down. And essentially what we're seeing is that the ATR is not a directional indicator. It is a volume indicator. The higher you see the ATR, the bigger the candles are, the bigger the move in any direction, whether it's up or down. If you have a market that's going completely high, completely low, completely high, completely low, you're going to see a higher ATR. When you have smaller movement like this, where you're going kind of sideways and the movement in the candles themselves are smaller, and essentially it's just a slower moving market, then you're going to have a much lower ATR because it's only showing you the range. It's not showing you the direction. Okay. Now, again, here's my issue with the ATR. One of the main issues I have is that it doesn't give you a differentiation between what is positive and what is negative. When you see the overall range in the market right here at 83 pips, okay, all we know is that when you account for every candle in the last 14 candles, it's going to give you the average number of movement, whether up or down. So sometimes those numbers can be a little bit skewed because when you have strong down moves like this, you have the majority of the movement that's being accounted for in this steep high on the ATR. You know, you see here, you got an average of 249 pips in the market, but you see that it's, you know, it's a lot of it is red movement. You know, it's a lot of red movement going on. And yes, there's some blue in there, but the majority of what you're seeing is red movement. And so, and that's where I have the issue with the ATR, because let me give you a drawing example. You can have a market that moves like this, okay? And let's say you have an ATR that shows 100 pips, you know, so you're getting 100 pips per candle, and that's all good. That's wonderful. So now you know, wow, we're in a pretty strong, fast moving market. However, here's the issue I have. When you look at something like this, you may have a couple of small red candles here, okay? And you may have a couple of huge blue candles here and a couple of huge blue candles here. And so you're getting 100 pips of bullish movement, but you're not getting 100 pips in the pullback. And so, yes, the average might be 100 because these are 120 and maybe these are only what, you know, so you're getting a bigger movement on the bull side than you are the bear side. And sometimes those numbers can mess you up because essentially when we get a reversal, okay, you know, kind of let me go back a little bit. You know, you have these big blue candles and then the smaller red candles in the pullback, but eventually this is going to pull back and you're going to end up getting red movement that's bigger than blue movement. And so when you have that number of 100 or whatever it may be, that is showing you the average range, but it's completely blue and not red. Now you've got red movement that is going to essentially do opposite, and it might not be exactly the same. You know, sometimes you see movement that looks like this, you know, and you might see, you know, where you have smaller red movement right here before you have this breakout. And so the ATR shows low, meaning that you would have set your stop loss tight and really only looking for a small move, but then you miss out on all of this because the ATR did not show you a very large number. My issue with the ATR is that it doesn't differentiate from the bull movement and the bear movement. It just takes all of the movement and puts it all together. So what I want to do is I want to show you another indicator that I feel is even more powerful, does a very similar job, but is even more powerful. And that indicator is called the vortex indicator. It shows you the positive and the negative movement separately so that you're able to differentiate between what is a bull move and what is a bear move. It's not an old indicator. It's not been around a very long time, although vortex strategy has been around a very long time. This indicator is fairly new, and not a lot of people are talking about it yet. It does everything that the ATR does as far as your true range. It shows you the range. It shows you the number of pips. It shows you essentially the volume that's in the market, the speed that's in the market, but it separates or differentiates between what is positive movement and what is negative movement. It does the same thing as the ATR in that it takes the high and the low of the candle and shows you the true range of that time period, but it only accounts for on the blue line, it only accounts for blue movement. And on the red line, it only counts for red movement. So it does, when it gives you your negative range, it's only giving you your negative range. It's not giving you range that is being skewed by positive numbers. And when it gives you your positive range, it is only giving you positive range. It's not giving you numbers that are skewed by negative movement. This can be very powerful when used right, because now you know what the average of your negative movement is versus the average of your positive movement. So now you can kind of see what is happening in the market you're in and not just an overall number. Every time you see that the blue line is above the red line, it's showing you that the candles are going up. And then every time you see the red line above the blue line, it shows you that the candles are going down. So essentially you have a 1.0 line, which is basically your zero, okay? And then you have your 1.1, 1.2, 0.9, 0.8. Essentially what that does is it allows you to see levels similar to like an RSI or a ADX or something like that, that kind of gives you an overbought, oversold type of situation. But in this case, it's not directional because it is only showing you volume like the ATR. So when you see the blue line up, it means that blue momentum, or essentially bull momentum, is in the market. When you see the blue line down, it shows you that bull momentum is weak and it is not a bull market. When the red line is up, it shows you that you're in a bear market. And when the red line is down, it shows you that you're in a bull market. It's a very powerful tool to have. And watch this. When you look at, like, let's just say this down move right here. When you look at this line and where it is, and you could just kind of see right where you are, right? So as you see this, then it has this little pullback and then it drops and has a little pullback and then drops, and a little pullback and then drops, right? This is just normal price action movement. And as you move down that, you can look at this little red number over here, and you can see as you move, that number changes, and it shows you how many pips you're getting on average in the red movement. What you saw during this bear move here, or this down move, is that when you got to the bottom, and you can kind of look and see where that number, you had an average of about 199, or let's just say 200 pips per time frame when you look at the overall spectrum. So over the last 14 candles or 14 hours, you had an average of 200 negative pips per hour, okay? And on the pullback, you had every time it pulled back on the blue candles, you had an average of an 82 pip pullback. So what you saw was that every time you had a pullback, you were getting about a 40% pullback each time. Obviously, you know that coincides with Fibonacci numbers. That gives you a great understanding of market structure, and it tells you essentially when these things pull back. If we have a pullback now when this, when this happens and you see that trend line break here, you can look and it's simple. Just look at your candles or just look at your pips. And when you broke this right here, you had a 200 pip move to break the trend line, 200 pips. Well, guess what? You had 200 pip momentum going all the way down and an 80 pip pullback. Now you have a 200 pip move. It breaks the trend line, but not only does it break the trend line, but it shows you 100% pullback, which means reversal, right? So we're no longer looking for a down move. We're looking for a buy move. What that does is it really allows you to understand currency strength analysis. It really puts you in a position where you can see the momentum shifting as it's happening, not waiting until after. And you can literally see by the math, by the numbers, that there are certain levels that will be broken based on how many pips we have in pullbacks, reversals, and essentially that coincide with our Fibonacci numbers. This is a very, very powerful tool when it's used right. And here's the other thing is, notice when we get that 200, when we get that 200 pip pullback, the next candle starts, and look what happens down here. Now, no longer do you have a red on the upside, but now you had this crossover where now the blue is on the upside. And so now you know that we can no longer look for a sell right now safely, because we are looking at a bull market starting up. And now, yes, we did have a little pullback here, but watch this. Look what happened immediately after. Completely bull move. And so it's a very, very powerful thing to know what's coming based on the number of pips that's in the market and what the buyers and sellers are doing in the market. This is a great way for us to know what the market makers are doing, simply because we look at the levels, look at the numbers, and see how much movement, how much money they're putting into the market to essentially move the market. And it really puts us ahead of the 8 ball here. It puts us ahead of the game. All right, so now let me show you a couple of things on how to really fine tune the vortex, and I think this will really help you out. So I told you earlier we had the line at the 1.0, so we're just going to drop that there, and we're going to show you that that is center mass. That is exactly at 0. That is where we're going to see most of our convergence, okay? Then if we take a line and we drop it on that 1.1, and I'm only dropping the lines just so you can see visually what we're looking at here. But if you look at the level of that 1.1, it's really strong where you kind of see the price continue to respect that. And of course, just like anything else in Forex, you know, we do support and resistance, and we look at zones. We don't just look at one line. We look at a zone, okay? So when you look at these zones, you look down here at the bottom, let's kind of come to that 0.9, and we drop that zone there. And it's very powerful when we look at this, because now we can kind of see where price is moving within. Here's how we can trade this. It's really, really awesome. When you see the red go to the upside, you sell. And when you see the red get to a point where it crosses out of here and you see it start heading back in and it touches here, you get out. Every time you see the red cross over, you go short. And you can take it right to here to where it crosses back inside of your zone. And you know at that point, it's over. And so you could literally take that, and in this particular case, you would have had about 450 pips in the market. Beautiful. You'd have had 450 pips. And you can literally do this stuff over and over again. Here, again, we see a red crossover. So we get in, and we take it all the way from up here to here. Now, in this case, we're in a stronger market with a spike. But even so, you could take it from there to there. You're up 228 pips in the market. Unbelievable. Really, really powerful. You can literally profit on this over and over and over again simply by taking the crossover and taking it to the opposite side. So now you ask me, well, what happens if it doesn't go to the other side? What if it, like in this case, it crosses over and then just comes right back down? That's a good question. But again, we don't do that. We're not taking this as a indication of a trade. We're only taking this as confirmation of what we're already seeing. So when we look here and we see a bunch of sideways movement, are we really looking to trade that anyway? We're looking for breakouts. And so that's right here. We see a breakout. We see a nice engulfing candle right here that engulfs the last 5 candles. And now we know we're looking for a breakout. We see it break out, and boom, we get in at the crossover. Beautiful. And we could literally take it right to the touch. You see it turn down, we're done. You can do this stuff over and over again, but it makes sure that you understand that it has to coincide with what price action is telling you. We don't just take the vortex indicator and trade it just because we want to trade it. We use it as a confirmation of what price action is telling us, And on top of that, we can use these numbers to set our stop loss, take profit levels, etc., simply by knowing these numbers. So here's a really interesting thing here. At this crossover right here, you see this crossover right here, and we wanted to take this short trade. So you say at the crossover, I'm averaging 98.8 pips on the negative side and 30 pips on the positive side. So essentially, I'm getting a 33% pullback at that moment, all right? So in that moment, I'm getting 30% pullbacks, 33% pullbacks, and I'm looking to trade that market profitably. So how do I do that? Well, if I know I've got a 30 pip average on the pullback, so if I know that I've been having 30 pip pullbacks at the time of the crossover, then I could take that number and times it by 2, set my stop loss at 60, and look at this line. It's literally right on my levels of structure previously. So I could take that and know that if I cross over that, I'm no longer looking at a down move because it's a full reversal. At that point, I could set my stop loss at 60 pips, and I know that I'm still targeting a minimum of 98 pips. So I'm still 1 to 1.5 on my trading. So, or almost 100 pips. So I'm a little bit better than 1.5 on my risk reward. And that pans out to end up being a beautiful, beautiful trade setup because I knew exactly where I was going based on the levels that I was given by the vortex and by market structure. Guys, this is a really powerful tool. It's not the only tool you're going to need. You definitely need to know price action. You definitely need to understand how to mark up zones and how to understand where levels are going to be. Over and over again, the vortex indicator is going to give you accurate numbers on what to expect the market to do, both positive and negative, based on the volume that's in the market and the money that the market makers are moving in the market. It's a very good complement to price action trading. All right, guys, there you have it. I hope this video helped you. I know that the Forex indicator is a powerful tool, not because it's an indicator, but because it confirms price action. I'm telling you, use this vortex, study it, learn how to apply it to your strategy, and it's gonna take you to the next level. So guys, listen, as I promised, I got something I wanna give away, and I appreciate you guys. We're over 17,000 subs now. The channel's growing, and we're getting thousands of views on these videos now, and I appreciate you guys' support so much. Some of you have been around a long time. Remember when we were less than 100 subs, and you've taken this journey with me the whole time. So I want to give back a little bit. So here's what we're gonna do. If we can get this video to 1,000 views and 100 likes, that's it. We do that anyway. 1,000 views and 100 likes, I'm about to bless somebody's Cash App. How about that? So here's what I need you to do to qualify. I need you to like this video. I need you to comment. I need you to be a subscriber. And then here's what I want you to do. I want you to hit me on social media, Facebook, Instagram, and let me know what your favorite thing was about this video. I'm gonna pick somebody and bless their Cash App today. Listen, we're blessed and we just wanna share that blessing. So as always, guys, like, comment, subscribe. If you wanna take this a step further, join our mentorship program, tradeandgetpaid.com. Go just check the comments. Our students are making money, and you can see that by checking our comments, all right? And check this out. If you're ready to catch precise entry on breakouts, I want you to watch this video right here because I promise you it's gonna take you to the next level. I'll see you on the next video.